Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com. Today's date, March 18, 2015. I'm going to talk to you a little bit about trading the FOMC statement, how to go about trading it. Before that, let me go through the preview here, or direct you to the preview, I should say. And the preview is brought to you by Ryan Littlestone, and did an excellent job of outlining the expectations and what he expects for the FOMC decision and what you should expect for it. So go to our website at ForexLive.com and look for the FOMC preview. You'll see it in this don't miss section right there, required reading. Now, whenever I take a look at a key event or release, I like to have a bullish or bearish scenario. And the reason why I do that is because I sent this benchmark and I have my mindset of what I'm expecting. And then we look for the price action in the charts, and we map out the targets either to the upside or the downside for our respective currency pairs. So with that said, what would be the bearish scenario, or the bearish dollar bearish focus if through the FOMC statement? And that would occur if they don't get rid of the word patient. I think it's as simple as that. Keep the word patient in there, and that's going to lead to a lower dollar. Look for the dollar to sell off, the euro versus US dollar to move to the upside, the dollar yen to move to the downside. That is our bearish scenario, our bearish benchmark. Now, what would be the bullish scenario? And that would be the opposite, that if they took out the word patient out of the statement. And if they were to do that, there is a precedent for taking the word patient out of this statement, and that occurred in 2004, the last time the Fed funds rate was increased. And prior to that increase, the word patient was in the statement for a number of meetings before that, kind of setting the stage for rates to be unchanged. And in March 2004, the statement read like this: with inflation quite low and resource use slack, the committee believes that it can be patient in removing its policy accommodation. So the word patient was in that statement. At the next meeting on May 2004, they took out the word patient and replaced it with this: at this juncture, with inflation low and resource use slack, the committee believes that policy accommodation can be removed at a pace that is likely to be measured. Now, what did the word measured mean at that time? Well, I'll tell you what it meant. It meant raising rates by 25 basis points from 1% to 5.25% every meeting. Is that going to happen this time? The answer is no. Okay, it's not going to happen. We're not going to have measured increases at 25 basis points at each meeting. That's not going to happen. So what is the Fed going to change the statement to read? And I think that's going to be something like this. At this juncture, the committee believes that a change in the target Fed fund range could be warranted at any meeting, provided that labor market conditions continue to improve. I think they expect that to happen, by the way. And on the basis of incoming data, the committee is reasonably confident that inflation will move back over the medium term toward its 2% objective. This is the big, but we still need to see and be assured that inflation is moving toward its 2% objective. It doesn't have to get there. It is not going to get there in this year, okay? But over time, they want to see things like wage inflation start to increase. What are we seeing? We're seeing Walmart increase their wages by $1. They didn't do that just because they're nice, okay? They did it because they had to, all right? They weren't getting the amount of employees that they needed anymore. Why? Because we're adding 250 or 60, 70,000 jobs per month. And those people who had to take the job at Walmart are not taking the job at Walmart. They're getting more permanent jobs, I hope. And that all ships get risen from Walmart, okay? And so I think the Fed wants to see these wage inflation start to, not inflation, but at least wage prices to start to move higher. They don't want to see wage inflation. They want to see a steady increase over time. It takes time to get wages to move to the upside. Think about your own situation. You don't get evaluated every month. You get evaluated on a year-by-year basis. If you just got a job 6 months ago during this rush to newer jobs, you're not going to get reviewed for another 5 or 6 months, right? And so it takes time, and that's what the Fed is going to be looking for down the road, is that people that got a job a year ago to start getting pay wages. People who got a job 9 months ago are starting to get pay raises. People who got a job 6 months ago are starting to get pay raises. And that should start to raise the boat for the wages, and that should satisfy the Fed to start the tightening process. Does that happen in June? Does it happen in July? Does it happen in September? that's what we're going to see. And so that is what the Fed is, I believe that is what the Fed is going to say, is reasonably confident that inflation will move back and they'll get it from the wage inflation. And then they'll put other conditions in here. It continues to be the FOMC's assessment that even after employment and inflation are near levels consistent with our dual mandate, okay, economic conditions may for some time warrant keeping the federal funds rate below levels that committee views as normal in the long run. In other words, we're not going to 5.25%. We're going to stay at 3%, or that's probably going to be a limit as far as how far rates go. They want to keep the market contained tomorrow by taking the word out, patient out. But they don't want yields flying to the upside with the expectations that rates are going to 5%. So there's going to be a lot of disclaimers, a lot of hedging going on in the statement and also in Yellen's testimony, so be aware of that. So now how to trade it. Okay, we have our bullish and bearish scenario. Now what if the word patient remains in there? What if the Fed is still a little bit chicken as far as the inflation? They don't want to change that patient word just yet. Well, that's going to lead to the dollar selling off. And what we've seen here on the hourly chart is the market's in this box right here, this box contained by 106.50 on the top side, and let's call it 105 on the downside, okay? On the top side, the first step will be to get through the 106.50 level. I don't think that's going to be a problem to get above that 106.50 level if the word patient remains in there. The step after that is going to be to get through the 200-hour moving average. Now, the 200-hour moving average is going to be lower. It's probably going to be around the 70 level or something thereabouts. It's currently trading around the 84 level right now. So it's going to be lower, and that would be our next step to the upside. If we get above the 60 level, get above the 70 level, which is our 200-hour moving average, look for support to come in against those levels on any sort of corrective move to the downside. That correction may start against the 38.2 of this move to the downside here. This is just the last trend move here where we created our channel here. That level comes in at the 107.12 level. So, and also we're going to have this top side trend line right here. So if we get a move up toward here and then a correction down toward the 200-hour moving average, look for buyers to come in against the 200-hour moving average. That'll be our line in the sand. We don't want to see the price move below that level. Okay, move above the 200-hour moving average. Don't want to see the price move below that level. That means that's your stop, okay? So be aware of that. Above that level comes in the 107.59 level. And what's the significance of 107.59? If I go back to 2003, the last time the price traded at these levels, and I took a look at the September 2003 low right here, what levels that come in? 107.59. The market remembers that. It was a swing low right here and moved higher off of that level, never to be seen again until this last month when the market fell below the 107.59 level. So 107.59 level is going to be another target on the top side. Let's go back to our hourly chart. If we move up to the 107.59 level, that would imply a trading range of about 176 pips for the day. That's about 50 pips above what is normal over the last 22 trading days. So I would expect that the market would have cause for pause at that level. In other words, we see a slowdown of the move to the upside at about the 107.59 level. So be aware of that. And then look for a rotation back toward the topside trend line. I would expect that the market keeps its little bullish bias here for the euro, at least for the time being, as the market digests what the Fed is going to do or not do going forward. Okay, so that's the bullish case scenario. Get above the 60 level, get above the 70 level where our 200-hour moving average is. Look for that level, then become the floor. Okay, and once we get above that, look for the 38.2, the topside trend line around the 31 level, the 107.59 level. That would be our target on the top side. We expect the market to stall. Now on the downside, I already mentioned that the 105 level was a low area of this box. Okay, so that's going to be a target on the downside. There's a closer target that we need to get below, and that is the 105.50 to 105.60 level. Now the 105.50 level was our low prices from yesterday's trade. We came a little bit below it came down to that 50 level not once but twice, and then rotated back to the upside. The 105.60 level, where I expected actually the market to hold in trading yesterday, is a level of significance as well. And again, if I go back to 2003 and I look at this low right here, what level does that come in at? 105.60. That was a low from April of 2003, bottom right here against 100-hour moving or 100-day moving average and moved to the upside. So a level that is of importance, and you can see that it was a level of importance in trading this last week or so of trading. We had a low here, fell below it, used it as resistance. you can see the, either it's above it or it's below it. Either it's above it or it's below it. Okay, so if we move below this 105.50 to 60 level, that's going to look for the market to use that level as a ceiling now, okay, as a ceiling, and look for it to stay below that level. We shouldn't go back above the 100-hour moving average, okay? Now, if we go below that level of 50 to 60, we're going to be looking toward the 105 level. And the 105 level, again, is important here on the hourly chart. We had a low right here at 105. We had lows right here at 105 right here. And we tried to use that level as a ceiling through here when we broke to below that level. Couldn't do it. Found support against that level. So the 105 level is important as well. Not only is it a nice little round number, but if you go back to 2003 and you take a look at this low right here in the month of March 2003, it came in at the 105 level. So hence the importance of that level and why the market stalled at that level. If we move below that 105 level, look for that now to become the ceiling, to stay below, okay? And if we move below that level, we're probably going to come down and test this 104.64 level. That would be our next target. That was our low price for the year and low price going back to 2003 as well. If we move down to our low price for the year, and we have the current high price, that would imply a move of about 150 or so pips to the downside. I think that would probably be enough where the market would have a cause for pause down there at the low level. It'll be difficult to get below that low level on the first look in tomorrow's trade. So be on the lookout for some buyers against that level. That could force the market back up to the 105 level. And depending upon what Janet Yellen says, we could see the market move back above the 105 level. From there, she's going to be hedging herself and hedging the Fed in her statement. So be prepared that we could see a movement down and then a rotation back to the upside as Yellen's comments become a little bit more, take a more hawkish, getting rid of the word patient and making it more dovish by the comments that occur after it. So that's a look at what I expect from a trading perspective for the euro versus US dollar. You can expect my report on the dollar versus yen on our website at Forex Live tomorrow. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.